And we are live. 3, 4, 5 seconds. And welcome back to this session of Options 101. Well, it is no longer Options 101, correct? And we have our BiOption scientist with us, Kun Hong. Let's welcome Kun Hong. Okay, Kun Hong. Oh, you got a huge amount of fans, man. Wow, I can hear the crowd getting louder each time that you come on stage. Okay, so now, Kun Hong, tell us more. Today, we are talking about shorting the market. Now, this is very interesting. By the way, I'm not sure how many of you guys understand what is shorting the market. Any one of you guys know what is shorting the market? If you know, can you please type in the chat group, inside the comments, so that we can also answer your questions. But in your opinion, Kun Hong, how do you read the market right now? Is it going to crash? Well, are we talking about shorting?
Originally, I maybe thought it was going to crash, but now not that sure already because of the latest news.
What about latest news? Tell me.
Yeah, because you can see the latest slides. Because before that, the US, not sure whether they will continue the relief or not. Because if the US totally stop the relief package, like the $600 a week for the US citizens, right? Then a lot of people struggle. Then it will directly affect the market very bad.
So it's in your slides, is it? Okay, so without further ado, let's go into there. What do you guys think? Is the stock market going to crash? Is this yours?
But before that, this one is answering someone's question. I didn't see.
Steady. Okay, so you are answering questions.
Yeah. So question number 1 is already answered by someone below, Julian. So the answer is correct. So the first question, for sell put, which we thought previously, we receive premium to get a promise to buy stock at a given strike price. So the question is, can we close before expiry date?
Right.
So the answer is yes. Because
the answer is yes.
Because options give you a choice from now until expiry date. If you are buying or selling, doesn't matter. You can close by right click and close. So you're just doing an close.
Okay, cool. So Julian actually mentioned, thanks a lot, Julian. So he's saying that you can close anytime. You just need to pay back the premium. Again, it is. I will just encourage investors to really test it out. Then you will know roughly how it goes. Yes. So question number 1 has been answered by Julian correctly. Thank you, Julian, very much. And then question number 2.
Question number 2. Tiger call. I didn't teach this but it's a combination. So it's basically you buy a long call.
Yeah.
So the first lesson, buy long call. After that, the sell call. So it's a combination of these two.
And sell short-term call. Okay, this one we haven't gone really into it, so we're not going to answer this because there's no proper lesson to this, correct? So no problem. We'll go through today's lesson, and then that's where you can combine your options knowledge and become stronger. Okay. All right. Next slide.
Yeah. So next.
This is where your prediction on whether the market will go up or down. Yes.
Yeah, but
what do you think?
Because of this new release, it's like 7 or 8 hours ago release only. So now that we have this news, first you can see that it will set enhanced federal unemployment income at 70%. So this thing is replacing the $600 per week.
Well, this is even more powerful. Depends on how much money they're making. So if they are making, let's say, $10,000, okay, but it must be federal unemployment insurance. Wait. So set at 70%. So meaning to say they will actually pay up to 70% of their wages, correct?
Yeah.
Wow, steady already lah. Okay.
And I think they want this because they want to. Actually, I think this is supposed to reduce the amount they get because previously it's like $600 per week. It's like quite high and a lot of people are incentivized to not work because if they don't work, they get paid so much don't work.
I see.
Encourage them to work.
So 600 is quite a bit for some of them, right? Yeah. So this one they will continue to get money, and did they mention until when? I have not read this report yet.
Yeah, so it's not that sure when it will end yet and they will set the benefit sum to $200 a week on top of what they normally receive.
On top
through September. So for now it's until September.
This one is until September. So for the next 2 months, 2 months plus, right? They will actually get a lot more like benefits, and they will be able to sustain. Wow, this is good news for a lot of people, correct?
No, you see, right after that, 70 replacement will take effect up to maximum of $500 per week. So it's $100 less than maximum.
They kept it at 500 instead of 600. So they actually spend lesser money. But again, what it means for the people or in US or anywhere, actually in US, people who are affected, they continue to get income, and this means a certain boost in the economy. So with that aspect, you don't think that the stock market will go down, right?
Yeah, because originally I was expecting the government to delay and fight. Then after that,
End of July, correct. Once July is gone, that's it. Correct.
Yeah, but now I think they are fast enough to release in time, so probably won't see that drop.
Right. So you're expecting the stock market to go up. So today, why are we wasting time talking about puts? Buying puts.
Yeah, even if the market is going well, there's still chances to earn money from puts. Like later, I'll show you examples.
Sure. Yeah. So tell us some of the reasons to buy puts.
Okay, so before we start with the reasons, I want to compare this buying puts compared to the traditional way of shorting the market.
Oh, okay.
So for shorting the market, usually it's because you are feeling bearish. You think the market will drop. So traditionally, usually people, what they do is they sell the stocks, then later buy the stocks.
So they sell the stocks first, meaning to say what they do is they sell first because people want to buy low, sell high, right? So they sell high and then they expect the stock market to drop and then they can buy back. So you can sell first and buy back later. This is called shorting the market. So is it only for short people?
No, some people also can use.
Some people also can use Okay, great. So what's wrong with this? You're saying comparing to this, actually buying puts is better. So what's wrong with this?
So the problem with this is it's very, very risky because when you selling it straight away, you owing the brokerage the stocks because you don't
you owe stocks, guys. You owe stocks, right?
So you get money first, but you owe people, and there's a lot of charges from it because of the margin.
So let's say you collect $1,000. Hopefully you can buy back at, let's say, $500, correct? Then after that's where you make 500 lah. But what happens if the stock price goes up? That's where I wait for the sound effect to finish. That's where you are in trouble because you collect 1,000 first. Later, who knows, it goes up. You may need to maybe pay maybe $5,000, and that's where you make a loss. So it is actually very risky, correct? So here you collect money first when you sell the stocks. Interesting concept, correct? They allow you to do that, and then when you buy, you pay back the money. So depending, if it goes up, you pay more. If it goes down, you pay less. That's how you make the money. So tell us what's the difference between buy puts.
So this one is unlimited losses.
Yeah.
But the buy put got limited losses. So you more clear.
Limited losses. So where's the one? Limited losses.
I did right here.
Okay. Limited losses, meaning to say, right, you do not expose yourself to unlimited risk. Okay, limited. So that's why people open company, private limited, cheat people money, then close the company down. Is it limited? But we are not asking you to do that. I'm just saying that when it's limited means that you are not exposed to the risk beyond what you have put into the market. So this is something very cool and something that I think investors, we got to know how to use really carefully to limit our risk. Okay? Yep.
So it can potentially have high returns depending on how you use it.
Yes, whenever we buy an option, that's where the returns can be potentially high. Whenever it's selling, you did mention it's always limited returns.
Yes.
Or this one you mentioned, safer than traditional method of shorting, which is this, which we definitely we are definitely against it because it's actually very scary, right?
Yeah.
Yep. Can be used to reduce money at risk.
Okay, so there's two ways to use this. One is to copy the returns of shorting the market but using a lower amount of money. Second one, which I don't recommend, is use the same amount of money that you originally risking, but your returns can be much higher.
Got it. So again, you're comparing this to the traditional way of shorting, correct? Yeah, shorting. Okay, shorting. Even though they give you money first, you still need to actually set aside. Do we need to set aside money? Well, depends on which market you are in. So, but the risk is significantly reduced when you use a buy put method instead of shorting the market. By the way, how many of you guys right now in the market right now? How many of you guys think that the market will go down? Do you think it's going to go down? It's going to go up? Can y'all please type at least for the next, I would say, 3 months before the election? Is it 3 months? Around there, correct?
Yeah,
before the election in November. November is not 3 months. Around there. Well, what is your prediction? Is it going to go up? Is it going to go down? Traditionally, well, I mean, there are a lot of factors in place. So traditionally, before the election, there are different school of thoughts. They say that the market will go up because why? There'll be a lot of stimulus package like this, so that they make you remember, hey, the government is nice to you, continue to vote for us. However, now there's COVID, there's a lot of trade war, there's many things going against it. So what are your opinions? Is it going to go up or is it going to go down? Okay. Yes. Okay. Oh, there are some questions here. Like, do you look at implied volatility, especially in current period? Implied volatility is pretty high by Bowen. Okay, so what is your answer to that?
The answer is actually yes. Implied volatility is kind of important when you're buying put, because when you're buying, right, you are paying for the implied volatility. So if the price of, if the implied volatility decrease, right, and the price go according to your direction, like you want it to go down, the price go down, but you can still lose money.
Yes. Okay. So this. Yes. Sorry, you're saying.
Yeah, because when you buy high implied volatility, then it drop, right. It can affect your price one. So
that's right. That's right. This is another factor in options. Options, they are altogether about 6 factors. So we learn them bit by bit. Each one of them affects the premium, affects your entry, exit, and also your returns. But let's go ahead and understand the full concept first, and then we can dive in deeper when you actually do your further studies. Now, gentleman Sean Ang say that buy put is unlimited loss when the market goes up. Is that accurate?
Not really, because when you buy put, you have the rights. So at most is how much money you put in gone only. So you won't lose any more than that.
That's right. Actually, traditionally, right. Maybe if I would just put it this way, just to make it a bit, from my perspective, when you buy a put, right, what you are doing is this. Initially, in the past, when people buy put, correct, they buy a put, is something like buying an insurance. Okay. So, for example, let's say they got stocks and their stocks is maybe at $10. They can buy an insurance for a $9 coverage. Okay, you can buy insurance coverage, correct? You can buy insurance covering your assets, like you can buy insurance for your house, for your, what else can you buy? For your stocks. I even heard one guy bought insurance for his cigarettes. Hey, this one's funny joke, you know. But by the way, I heard it's a true story. This person, he bought an insurance, fire insurance, for his very expensive tobacco. You know tobacco, right? They used to smoke. After that, he go and smoke and then he burn it off. Then he go and claim insurance and say, hey, now you see my asset get burns. I want to claim insurance. Then he actually won the case, you know. He won the case because he buy insurance and now he can claim back the money. However, the insurance company counter-sue him for arson. They say, hey, you go and burn your own property, so we're going to sue you. Anyway, the whole key idea, okay, let me put some laughing sound. It's meant to be a joke. Hey, but it's a real story. But anyway, what I'm trying to say is this. When you buy a put for your stocks, you are buying insurance coverage for your stocks. So example, your stock price is $10 right now. You can buy insurance coverage at $9, $8. You can choose different strike price. And so remember, when you actually make a cover or buy insurance coverage for stocks, you have to pay some insurance premium. Let me just give some example. Let's say you pay $1 for the premium. Now, if you pay $1 for the buy put, which is the insurance coverage, whether the stock price go up or go down, actually, that's the maximum amount that you need to spend. So therefore, it is actually limited risk. It is not unlimited. Does it make sense, guys? But if the price drops, that's where you make money. If the price goes up, maximum you lose is that $1 of premium that you pay. So it is a safer way to do shorting. Am I right to say that, Mr. Professor by scientist who hasn't graduated from your university? Yep.
Yeah, so it's a safer way.
Yeah, okay.
And we normally, I think people usually don't buy put for shorting the market. Usually it's those bigger players just buying insurance for their stocks. It's just that they are also using it.
Okay, hey, by the way, well, a lot of people got affected by you. They say the market is going to go up. Casey says up. Irene says up. Angel says up. Goes up before election. This is the power of what you can say over Facebook. I'm not too sure whether you all did your independent studies. Will not recover before. Okay, yeah, because actually earnings still going on. So the next 2 weeks quite exciting. We will see what goes on. However, regardless whether it goes up or down, the cool thing is when you can limit your risk and then you can take a certain direction, you can see it's pretty safe. Imagine you just bet a bit go up, bet a bit go down. Regardless which way they go, you still make money because you have limited risk but unlimited returns. However, that also requires the market to move big enough. It's called a straddle. Many ways to do options. Yes, let's go back to the essentials.
Okay, so in case you haven't watched the previous one, options is just like a contract to promise to buy and sell at a fixed price.
Cannot be lah. Everybody who have watched the previous one, because you have huge amount of fans, correct? So yeah, correct. Options is a contract. Is a contract, and there are two types: call and put.
So today we are talking about buying put, the
Buying
final
put,
quadrant.
the final quadrant on the right side. So it's the right quadrant. Yep.
Okay, so this means we have the right to sell. That means we are in control lah. We won't get assigned, so it's safer lah in that sense.
Correct. You got it right. So like what we mentioned just now, it's like you buy an insurance. So you buy insurance, you buy at your stock price insurance, you cover your stock price. Say, okay, I cut my insurance coverage. Let's say we buy a 9 put. We buy a $9 put. What it means is we have the right to sell our stocks. So let's say this is your stock. You can sell it at $9. Do you need to sell at $9? Answer is what? Answer is no. So you have the right to sell, but you don't have to sell at $9. So this is like an insurance coverage. So you only exercise the right if the stock price crash. If it crash, then you say, oh, okay, I can sell it at $9. This is one way of looking at it. This way is called hedging. You buy a put to hedge. But interestingly, I think today you're going to share with us, even if you don't have stocks, right? Even if you don't have stocks, you can also buy a put, correct?
Yes, that's a special thing. Because when you sell call, right, you're obligated to fulfill. But now you have the rights, so you don't need to have the stock. You can just don't have the stock and just buy put.
Whenever you sell, you always have the obligation, correct? But when you buy, you have the right. So you can buy insurance for a house, but you don't have a house. Then they say you sell. You don't have a house, you go and buy insurance for a house for what? Well, there are ways to actually do this. It's very, very interesting. So let's go ahead.
In fact, the insurance company will be happy because you don't have house means you cannot damage your house, so it's like free money to them.
Okay.
Not sure.
Yeah, not sure. Don't know whether this is accurate or not. So got insurance company out there, you can tell us whether this is accurate. Okay.
Yeah, so
okay, now. Okay, story example. I love your stories. It always doesn't really make a lot of sense to me, but I love listening to you. No,
so that is the same picture. But this side we are on the different side. Now we are the fund manager.
Yeah. Now we are the fund manager. Sorry, we are the fund manager. Yes, this is us. Where's Tony Stark? I thought you'd like to use Tony Stark one. How come disappear today?
Oh, that one is only when call. So put is to have Tony Stark.
Okay, good. So we are the fund manager. I put some eyes. Wear specs. Wear specs more sophisticated. Look at both of us. Wear specs. Okay. The specs a bit high. Doesn't matter. Okay, so tell us the story.
Okay. So previously we are the insurance company, but now we are the fund manager who's buying insurance. And unlike traditional insurance, stocks is different because normally traditional insurance you need to go like health check. You must declare and disclose everything to make sure you don't defraud the company.
Oh, you do that or not?
No, I don't do that. Usually people cannot do that. If they do that, they will get punished by like no claims or something like that.
Yeah, correct.
So stocks is different from normal traditional insurance because we can actually choose. So instead of choosing a healthy person to buy the insurance, right, you can choose a sick person to buy the insurance. So
we buy insurance. So we are going. Wow, this is dirty, man. This is a dirty trick, man. So you're going to buy insurance for sick people. Insurance.
Buy put for a sick company.
For sick company. Wait. I just want to clarify because nowadays the young people's lingo is getting me confused. Last time when we say sick, right, it means like it's like you're not feeling well, you got illness, correct? But nowadays when I say you're sick, man, it's actually saying that you're quite good. You are sick. Okay, so are you sick or are you sick? So what are you talking about?
You or not feeling well company.
Okay, lousy put lousy company. Okay, so lousy company. Yeah, so buy put for lousy company. I'm going to put a question mark here. I see people's head got question mark already. Yes. Why do we do that?
Yeah, because this strategy works when the company price drops. So if you're choosing a very good company, you are shooting yourself in the foot, which I did last time.
You shoot yourself in the foot and then claim insurance, is it? Is that what you did?
No, it was funny.
No. Okay, I'm just talking. Okay, so we are buying a lousy company because we expect the share price to drop. So can you name me some lousy companies?
Wow, sensitive. I say any company later I get in trouble.
Yeah. You say now, I tell you, you cannot sue. Okay, so then you should insure yourself. Okay, never mind. Let's go back to that. So assuming, then we cannot use examples. Okay, those
examples is not lousy company. It's just that their financials are not so good. That's why I'm using as an example. So I'm not saying that they're bad, but I can make money of
Financials
them.
not so good, but they are not lousy company. You are not a very good politician, but I can tell you that. Okay, but remember, this whole entire, when we buy put, right, it is when we expect the stock price to drop. It can be because it is a good company with lousy finances, which I don't know what I'm talking about. Basically, the share price will drop. Either market crash or you believe like it is overpriced and it will drop. If you watch this movie called The Big Short, they actually short companies because they expect price to drop. Now, in this case, instead of shorting, we buy a put. So let's explain. So we actually buy an insurance policy, right? Insurance policy here. Yep.
So instead of shorting, we just find a very ill person, like got family history of diabetes, cancer, all this. We know that most likely will kena. Then after that, we just buy the insurance, which is the buy put option.
So you go and find very unhealthy people who is likely to be very sick, and then you buy insurance for the person, and then hope that the person die. Walao,
and this is for the company.
Okay.
So I analogy.
Very negative, Okay, but this is what people who actually buy puts for stocks do lah. So they buy a put, it's like they're buying insurance. So example, we can buy a put at shall I put $10? I put $10 is zero, right? $10 insurance coverage for a stock. And interestingly, we don't have the stock, right? You're saying?
Yes, we don't have it.
We don't have the stock. But remember, let me go back one slide. When we buy a $10 put, what does it mean? It means that we have the right to sell the stock at this price. So we can sell. We can sell at $10. So why do we do that? Even when we don't have the stocks?
For example, if the stock price goes to zero, if the company goes bankrupt, it will be worth $0. Okay, so you can buy the company at $0, then you forcefully sell to someone at $10.
Hey, so this is the cool thing, guys. Do you all see that? So this whole entire scenario, we do not have the stock. Shorting, right, makes you actually need to have the stocks in the future. But you see, the whole point is this: you do not have the stocks. Okay, can you all please type no stocks? Without any stocks, but you expect the stock price to drop, it is a little bit like you can, like what we mentioned now, we buy insurance on stocks. So in case the stocks drop, okay, in an extreme unlikely case where it goes to zero, what you can do is you can go to the stock market and buy it at, you can buy at $0, man. Hey, give me a better example. Your example,
okay, 1 cent. Open the counter, so at least like 1 cent.
1 cent, okay. Let's say, you see, I need to cancel. Okay, so can I put $1? Easier to calculate.
$1 easier.
Okay, so the stock price dropped to $1 because I don't know, Donald Trump tweet and say that he's going to nuclear bomb this company. Let's say it drops to $1, correct? What happens is you can go in and buy. You can buy stocks at $1. And remember, you already lock in the price to sell. You have let me go back one slide. You have the right to sell at the strike price. Strike price means the price that you agree, which is $10, correct? So in other words, you make $9 per stock. Hey, how did I make $9? Because you buy at $1 and then you can sell at $10. So this is a smart way of shorting a particular stock, which you think is unhealthy, that can go down. Wow, suddenly everybody very happy already, because nowadays many company looks like they are not very healthy, right?
Yeah.
Oh, you got unhealthy stock, is it? All right, man. Let's clap for you first before you go to jail. Okay. So this particular stock, why is it unhealthy?
So which one is Neo lah? It's one of the new startup trying to compete with Tesla for EV. But it's like not really EV lah. It's like another sustainable energy one, but it's not as proven as Tesla yet. So like Tesla is negative lah. You see the financials mostly negative, which is very bad. Negative. So just because it's negative doesn't mean it's a lousy company. Because a lot of good companies, those innovative companies, they will lose money for the first like 5 to 10 years. But after that, it's exponential growth. But only if they succeed. But if they fail, then it will go down the drain.
That's right. Oh, wow. A lot of people say that there's many lousy companies. Mahdi, yes. There's quite a number of companies, they purposely write bad reports about company, and then they short the market, and then hope that the market the price goes down. That's where they make money. So yes. Using this example, Neo, maybe we'll go in a little bit more details of what criteria we choose. Is it going to be leap option? Do we look at other criteria? Thanks a lot for asking these questions. All right, let's take a look. So negative doesn't mean it is bad company, but it means that it is
risk,
a potential candidate for you to want to do shorting. Maybe correct. Okay.
Yeah. So next,
I'm looking at operating cash flow also quite bad. Okay, so got quite a number of cracking points. Working capital is negative, and great, excellent. This is crazy. When we see negative, now we say excellent because it's a potential for shorting. Okay. Yep.
Okay,
So
this
what
is
do
the
we
chart.
think?
So I also don't know why there's a sudden super high jump during
Super high jump.
July.
Okay.
But it's okay. When this something happen, there's two paths. One is it continue to shoot up like Tesla, or second, if it's not as strong and good, it will surely drop down because people will start to realize they're overpaying.
So it's either go up or go down. Wow, I love your prediction. Cannot be wrong, correct?
No, can go sideways, but unlikely.
Can go sideways, but unlikely. Wow, he makes. I tell you, his prediction 100% correct. It's either go up, go down, or go sideways. I love it, man. This one, it's like basically you wasted 1 minute of everyone's time. Okay, tell us what to do with this.
Okay. So for this one, I don't think it'll be going up because they have not proven themselves. They probably cannot scale, and basically they're not as strong fundamentally as Tesla. So they will be either have internal problem or competition will win them. Then it will slowly fade.
This is what the BiOption scientist say because he's a big fan of Tesla. Okay.
Yeah. So this is maybe because I like Tesla, that's why I short this one instead.
Okay, so a bit emotional already, these guys. So this one is emotional. What do you call that? You are really like
so this one.
Tesla, that's why you boo. Hopefully this company goes down. Yes.
And please
China
don't.
company, right? Is it China company?
Is it China company? Not exactly China.
No, not exactly. Okay, great.
Yeah, and please don't execute buy put on this company. Got a better example later. So just.
Sorry. So don't execute buy put on this company.
Just an example only.
Okay, example of what? Then don't do buy put. Then what is this for?
Oh, this one can lah, but later got a better example. So if you more different.
You waste our time lah. Can go to the good example.
You want to skip then skip.
No, it's okay lah. You say don't buy put, then you go and demonstrate buy put. You know, it's like you tell children, hey, don't play fire. Then you put a hand, hey, don't play. Then you show them. What are you talking about? You scientists cannot like that one. You know, you must be.
Don't worry. The next one is I apply surely.
Okay. So, but this is one possibility. Buy put. Okay. Hey, I'm going to skip this. Let's go to the good one. Phillips 66. Is this a bad company?
So this may not be a bad company, but I choose it because of the industry. It's actually oil and gas refinery. So later you'll see why it's very, very in deep trouble. Okay. So the financials, it doesn't look that bad. It's not like negative all the way. But actually, if you see closely, right, the revenue is like decreasing and they stagnate.
Decreasing, you can see, is decreasing over the years. Okay. And then earnings is also decreasing. Okay, wow, it hits a all-time low. Okay, anything else that we can?
Gross margin is not good.
Indication where margin?
Gross margin, upstairs.
Gross margin not bad, what? 10 point something. Okay.
Oh, I thought I see the 9.7. Okay.
9.7. Oh, I mean, okay lah. I mean, actually, gross margin haven't calculated a lot of things, so may not be that good lah. I think by the time net margin almost nothing left. So you can see their revenue is 105 billion. Their net income is 300 million. So it is 0.3% of net margin. They collect $100 from their customers. They are left with 3 cents, which is pretty dangerous. Okay, so this is the idea. Good. I mean, good.
Free cash
flow. Bad. Okay. What's this?
Later. Haven't yet. Go back previous slide. So the free cash flow, sometimes you see positive, very high. Then sometimes you see negative. Then last year is quite high. They got 4.9 billion last year, but this year suddenly dropped a lot. Then it may go even worse. So it's very unstable.
You can see the capital expenditure is very high. So again, not necessarily saying that this company is bad. In fact, Warren Buffett bought this company heavily in the past. I think he may be still holding some of it. But our BiOption scientist thinks that Warren Buffett may be wrong again.
Yeah, maybe because I just don't like the whole oil and gas industry. I don't think it's going to do well in the future. Because in the future, sustainable energy will replace it. So sooner or later.
Wow, I love this whole idea. Actually, I like a lot of things about clean energy. So you can see, right, guys, very interestingly, right, one of the key points is when you invest into a future that you believe in. Correct. When you invest, you're saying that in the future it will be clean energy, it will be people watching more Netflix and spoiling their eyes. It will be quite a few things. People still eating McDonald's. So this is the future, correct? A future that you expect it to be. However, things that will not be in that future maybe can be a candidate. If you are interested in shorting, you can actually look at what will be irrelevant in the future. So they will be affected, correct?
Yes.
Yes. So this is one way of making money through optimism. So nothing wrong. No need the wrong button. Let's go and take this as an example and see how it goes.
Okay, so next slide.
Yep.
It's just the financial valuation.
Yep.
So as you can see, right, the previous few years, the price to earning ratio is reasonable last time, like 11.
Last time is reasonable, 9, 6. The most go up to 20, and this year,
suddenly you see, wow, something wrong already. 97.
Wow, something wrong. Okay, something wrong because the earnings has dropped tremendously, and that's why it's an indication for overvalue also, potentially overvalue, right?
Yeah. So
yep.
When you see this, you either think that either the earnings drop a lot or the price increase a lot. But you go to the next slide, then you see actually the price is decreasing already. So by right, the PE should be decreasing also. But
correct.
The PE suddenly shoot up so much. So
so the fundamentals, the earnings drop even more. Yes. The earnings coming out in August, and July, correct? Oh, so interestingly, so you're betting, possibly, I'm just guessing, you're betting that the next earnings, right, they will report even worse and the share price will tank further. Is that what you're thinking?
No, when I originally choose this, I didn't actually notice the earning, but doesn't matter because with or without earning, I think long term will do that.
Okay, cool. Sure. Then are you going to place a?
Actually, I intend to place an order tonight. So.
Oh, he's going to place an order tonight. Okay.
But you don't know, just don't anyhow copy it. Okay, so
that's why they come and listen to you, ma. But you waste our time, tell us lousy examples, and give lousy companies that is not. Give lousy companies that's not really lousy. Okay. Anyway, the key thing is you're going to buy a put on Phillips 66, right?
Yes.
So buy put. Okay, let's go through this. Is it a bit small? Let me just see.
Yeah, it's a bit small.
It's a bit small, correct? Let me zoom in. Let me change this slightly. Okay, you can continue to entertain them first.
Okay, so for this one, there's a few criteria that I look at.
Yeah.
But since it's not a very popular stock, there's not a lot of options. Because some stocks every month also got different options one. Some is less frequent. So,
okay. This one, do you still choose open interest and stuff like that? Do you have a summary slide on that?
Oh, I don't have a summary slide, but I still see open interest and other stuff. Because you can see from this slide itself.
Okay, great. So right now, the stock price is 64, correct? Let me go back a bit. 64 is right here. And that's where you think there's potential that it can go down further. Okay, yes. Because for the next 1 month, you're going to go on oil strike and not going to use anything that is oil, correct? Oil-based. Oops, am I getting stuck? Sorry, talk too much nonsense. Okay, so this one is the price now is 64. And what you did, let me look at this. You bought a put, PXX put, 20th November 2070 put. 70 put. Yep. So what is happening, if I may, I'm going to just draw this over, correct? What is happening is the price is right here now, 64.59. Okay. And then you buy a put above, higher, correct? At a higher price, 70 put. And how much do we have to pay for this? Let's take a look.
11.1.
11.1. Wow, so cheap. But actually, remember, every single option, it's multiplied by 100. So you have to pay 1,110. Wow, nice number. Okay, so you are paying this insurance premium is 1,110 for this put. And this put lasts until 20th November 20, which is just a couple of months, right?
Yeah.
How much?
So usually I will buy about 90 days to 150 days, the expiry.
90 days to 150 days. Is there a reason for that?
Yeah, because you don't want to buy too short. Because if it's too short, the time decay will eat it too much.
But you're shorting the market, right? Why you don't have to buy too short? Okay.
Because you don't have enough chance. So what if the market suddenly shoot up for a while only, then after like 1 or 2 months, then it finally plunge a lot.
Okay, great. So the first thing is you're going to buy a put that is higher then current price. Second one, you buy at a time frame that's 90 to 150 days. And the premium you have to pay is 110. Remember, guys, when you actually buy a put, right, what you do is you give yourself the right. You buy over the right to sell. You buy. Oh, this is confusing. You pay money. You pay 110. Okay, to lock in the rights to sell your stocks at 70. Okay, does it make sense? So you pay money to lock in the rights to sell stocks at 70. So in this case, you're expecting it to drop until how much?
Less than 55 lah.
Less than 55. So I'm going to put 54. Okay, I'm just going to put 55 lah. Don't confuse the audience. Okay, so if it drops to 55, right, guys, what happens is you can actually, technically, you can buy the stocks at 55 and sell it off at 70, making a $15 profit. This is the theory portion, right? So it will increase it's sort of like value of the options. Yes.
But must minus the 11.1, so it's actually like $3.90.
Yeah, but actually the thing is you don't really go and exercise the option, right? So guys, let me see whether do you see any questions down there, because I can't really see the comments right now. I'm zooming into this.
No, not much.
No much questions. Are they still there or not? Or everybody gone already?
One is when you exercise a buy put, do you have to literally buy the shares from the open market to sell? How does it work operationally?
When you exercise a buy put, do you need to buy the shares? No. When you exercise a buy put, you sell the shares.
Yeah. So you can just sell the shares that you don't own, then you owe the brokerage, then you can just buy it afterwards. Or you can buy first and sell.
That's right. So operationally, right, if you click exercise, there's a button called exercise. If you click exercise, right, what will happen is you will sell the shares at $70. Okay? Then it's 100 shares, ma. So what happened, right, is your brokerage account, right, will suddenly have an increase of $7,000. Literally, there will be an increase of $7,000, but the brokerage will also lock in the fact that you owe them 100 shares. Okay? So if you owe them 100 shares, right, you must buy back 100 shares so that you don't owe them anything anymore. So make sure you do that before Chinese New Year, because for Chinese, we don't like to owe things over Chinese New Year, correct? Now, so how much? Actually, you should buy back as soon as possible, not Chinese New Year. So you buy back the shares, correct? You buy back 100 shares, but the price that you buy back these 100 shares will be the market price, which in that case probably drop under 55 already. So you buy back at 55 after you sell them at 70, correct? So you have to pay 5,500, right? So this is how you make money. But this is how, on theory, you make money. But tell us exactly what do you do?
For me, sometimes I don't actually exercise and do all this. Sometimes I just right click and close because I just don't want to do all those troublesome stuff.
Okay, guys. Actually, what you should do is you should close the option. Now, again, if you do not know what's close the option, I'm not sure whether in the previous few videos did we talk about it. Close the option is this. Huh? Did we talk about it?
You even showed a live example of how you close it.
Okay, please go and watch the previous videos. Later we'll give you a link. You can follow Kun Hong on his page where we talk about all these things. Now, when you close the option, right, it means this. Because right now, let me explain this. We actually bought an insurance, right? We bought an insurance. Now, this insurance, right, there are a few things you need to know. The insurance has a value. Do you know that insurance policy has value? I'm not talking about investment-linked policies or things like that. But basically, right, you must understand something. The insurance policy will have value until it expires. Okay? So what it means is this. I think you're going to talk about time decay, right?
Yeah, later on.
Yeah. So what it means is this. If you go and exercise the option, for example, right now today is July, correct? July. And then there's time value from July until November. So understand this, guys. So every day, right, if let's say the price doesn't really move, every day the option is worth lesser and lesser because it's going to expire soon, correct? Going to expire soon. So every day going to worth lesser and lesser until the last day. Then suddenly it's worth $0. Now, what that means is also every single day, actually there's still value. There's still value. So let's say in September, on September 11, something happened on September 11, right? You know what happened, Kun Hong?
Yeah, I know that, but
you know what happened. No, because but by the way, sometimes the stock market is very interesting one. They remember certain dates, right? And they feel that on this date, stock market crash a lot, therefore it will crash again. Somehow people have this belief. So because they think it will crash, they go and sell the stocks. That's why it crashed. Now, let's say on September 11th, right, the stock market really do crash. So this price really goes down. Now, instead of exercising and then go and exercise means here, look at my mouse. Exercise means what happens is you go and when you exercise, you sell stocks. You get money first and then you buy back later. Now, instead of doing that, right, what you can do is you can simply close. Close means you sell away. Okay, now you are holding. You buy an insurance policy, correct? On that day when you close, you sell away the insurance policy, right? The insurance policy will be worth a lot more. Worth a lot more. Why? Because this insurance policy allows people to sell stocks at 70, but the stock price now is 55. So by the nature of the stock dropping, right, this insurance policy's value increases. If it drops further to 30, the insurance policy's value will increase even further because the price is already locked in at 70. So the more it drops, the more value the insurance policy is. But there's one more factor. One more factor is called the date to expiry. They call it DTE, date to expiry. Now, the date to expiry, right, by virtue that there's 2 more months, correct? There's still 2 more months of time value. If you go and exercise immediately, right, that 2 months of time value disappears into thin air immediately, like how Harry Potter make the orange and apple disappear during the magic show. But the thing is this, so during this, so there's still value for these 2 months. Instead of exercising and let these 2 months value disappear, what you can do is, remember, this amount of premium that you pay, 1,001, okay, what difficult number. Okay, this amount that you pay, right, includes time value. So when you close the whole entire insurance policy, okay, instead of exercising it, you can actually get back the value in terms of the share price drop plus these 2 months time value. So you get back more money than just exercising it, typically speaking. Okay,
but sometimes it's better. Depends on the situation.
It depends on the situation, definitely. But typically, it will be better. You know what? If the stock price drops so much, the volatility also increase and quite a number of things. Yeah. So it's typically better to close than to exercise. Typically, okay?
Yeah, actually close.
Yeah, so if you are confused by what I'm saying, excellent, because it is lunchtime and we haven't eaten lunch. So go back and rewatch this video, okay, Ken? Now, do they have any questions? They know what we're talking about. Why? If stock price drops so much, why would anybody buy my sell put contract? Buy my sell put contract.
Oh, so if it drop a lot already, right? The person
who buy your sell put contract, they were you are selling to them.
The next person is expecting to drop even further. So I think it will stop at 55. But maybe someone think, it will go down to $40. Then he'll buy from me and continue to hold it.
There will always be some xiao kiang outside on. Okay, xiao kiang means people like Kun Hong. No, I'm just kidding. So you see, the interesting thing about stock market is this. If everybody thinks the same way, okay, so this gentleman or lady, I'm not too sure your name. So you see, if the price drop, right, some people will think, hey, it's a good time to enter even more, right? They will think there's momentum. So at each point in time, I heard an interesting quote. When we buy a stock from a stock market, right, when we buy a stock or when we buy an option, someone is selling to us. There must always be someone transacting with us. And both of us think that we are correct. So there's a lot of people thinking differently, okay? Don't worry about that too much. Okay, so what is the consideration for locking the price at 70? Is it because
that must go back to the slide? Because a lot of things is in the slide.
Oh, in the next slide, is it? Okay.
So because just now you draw a lot of things.
Right? I draw a lot of things on. Wait, I go back to the one that I draw a lot of things, guys. Wait, hang on a minute. Yes. Okay. Yes.
Yeah.
Let's go for it. Oops. Am I blocking it?
A bit. Can you erase the things? Or?
Yes. I can erase. Okay. Take a screenshot. Bye. Gone. Oops. Okay. Where's my slide? Yeah. Okay. Great. Can see y'all? Yes. Is it this one?
Yeah, here. So the first criteria I see is open interest. So you zoom in to the open interest area.
Open interest, okay.
It's one of the highest open interest. So got 2 others similar. One is 72.5 and another one is 57.5. All the way upstairs.
So he go for the highest open interest. Okay, great.
So all these 3 are possible candidates.
Okay, so there's 3 candidates, and why do you choose this one? Why do you vote for this one? Who do you vote for?
I vote for 70, obviously.
Okay, You vote for
Okay.
70. I thought you were going to tell me which political party. Okay, but never mind. So 70 and then?
Okay, so
Why,
second one is how much the price will drop. Because if you buy the 57.5, you must wait for the price to drop even more before you start earning money.
Oh
So
yeah,
it's like
remember
harder to-
the price now is 64, correct? 64. So what happened is, sorry, I can draw again. Is it okay to draw? Can I?
Okay,
So
here.
what happened is the price here is 64. If you go and lock in at 57.5, which is here, the insurance 57.5, right? So this one you must really curse that
drop.
stock a lot. Yeah.
It must drop to below 52. I think.
Okay, you must drop to below 52. Then you can make money. Okay. Yes.
Yeah.
So that's why you eliminate this one or this one.
Yeah,
Too
so I
stressed
don't
already.
really
You need that stock to really die big time. Then you can make money. So left with these two, 70 and 72.5. So why do you take 70?
So move to the right a bit.
Move to the right a bit. Okay.
Next, I see extrinsic value.
Extrinsic value.
This is basically how much we are paying. Okay, not really. I just calculate how can I earn the most amount of money with this amount I put in. So I think it's more efficient for 70 than 72.5.
Okay, so you actually look at the bid and ask price, right? So for this 70, you have to pay about 1,001. Okay, you bargain a bit, becomes 111.1. For the 72.5, you need to actually pay 13.10, correct? So this is based on your capital, and then you look at the potential amount that you can make back, correct? Which is about 55. So your budget a bit tight, lah. That's why you want to save the $200. Is that the reason?
Yeah, and also more people prefer the full number, like end with 0 or 5 better.
More people
usually don't like 5.
You go and check what feng shui or this kind of thing, no, right? What I'm talking about? Okay, I'm just talking cock. Okay, so basically he has certain preferences, lah. But again, to round up, number one, look at open interest, see which one got the highest open interest. The second thing is really based on the potential ROI. So by spending lesser money, right? Okay, what is ROI? ROI is very important. It's return on investment, correct? So now your ROI is much higher when your investment amount is lower. So instead of spending 1,003, he spent 1,001. So reducing the investment, and that's where after some calculation, of course the returns also reduce, but it reduces lesser than the investment. So in the end, the percentage is higher. Am I right to say that? Is that what you're trying to say?
And actually, if you see purely based on ROI only, right, then actually the 57.5 is higher.
57.5 is higher. Yeah.
But the reason I don't want to use that is because it's harder to earn the money.
Correct. The price need to really move a lot more downwards before you can start to make a lot of money. Because okay, this one is $500 only now, correct? However, the amount that you make back, well, the percentage is higher, but in the end you make back lesser money, correct? Is that what you're saying?
Yeah, unless it dropped by a lot, like go down to bankrupt, then the one at the top is better. But I'm not so confident that it will drop so much. So I rather.
You're not confident that Philip 66 can drop so much, okay?
So I rather choose the higher price.
So it means you're not confident,
No lah, it's just that.
Sorry, I'm just
like
trolling.
High return it's balancing act So it's no fixed rule. It's just up to your preference.
So balancing act, no fixed rule, up to your preference. So in other words, guys, he don't know what he's talking about. No, I'm just kidding. No, I'm just kidding. Okay, so again, I'm just trolling you. My job is to make you look funny now. Okay, so anyway, okay. So the key thing is this: he has his criteria, and it's very important to have a set of criteria. So number one, open interest. Number two, if it's too far away from the current price, you need it to drop by a lot, right? It's a bit stressful, and you may not hit it within that time frame, right? This amount of time, which is 90 days to 150 days. And finally, is really about the capital that you want to allocate. So that, okay, but this also means that once you understand options, right, because there's so many variables, it is a lot more flexible also. You can choose based on budget, you can choose based on time frame. It is very cool. Okay, cool. So this is something we want to say. Yep.
Oh yeah, and before forget, please do not allocate too much money using this, because that is like considered as high risk, high return. So please do not all in, don't show hand. At most like 5% of your capital, don't put too much in.
Okay, this one is pretty high risk, right? Being the reason for this. Now, okay, so maximum 5% of your portfolio. Well, in case your portfolio is really not very big yet, right? Try to avoid this strategy. Reason being like 80% or 90% of the time, the stock market goes up. Yep. So in that 20% of the time, yes, it goes down, but you must catch it correctly within within the time frame that you allocated for it. Sometimes it may not happen, right?
Sometimes, right, you will see profit, then you're very happy. Then you still think, oh, you'll continue to go down, but suddenly it shoots up. Then you could have earned money, but you lost money.
You sound like you are speaking from experience.
Yes, happened before.
Okay, sorry for laughing at you.
So apart from choosing the right entry, you also need to know when to exit. So
yes.
some people say like, oh, once I have earned 20%, I'm happy already, I fast exit. Someone 50%.
So what should be a good percentage to exit?
This one is up to individually. This one I shouldn't comment. Different people have different appetite. So
What's yours lah? What's yours?
mine is around within 20 to 50% lah. I won't wait too long.
20 to 50%. Hey, there's a big range, bro. So it's 20 or 50.
Depends on how
there's
negative
a
I
difference,
feel.
right? Huh?
I think the company is not good, then 50 if it's still not so bad one, then 20
Okay,
Depends
so
on
like
how-
Phillips 66, in terms of Phillips 66, what do you think? Like using this case study, do you think it is the 20% range or the 50% range?
somewhere within 30 to 40% range.
30 to 40. Okay. Hey, don't forget, this one, if it drops far enough, Warren Buffett may come in and buy, and then he will turn the price out already. So this one, you got to be careful also. Once you hit a certain percentage, well, you requires a little bit more monitoring. But if you believe that the stock market is going to crash, maybe just for the, okay, I'm not encouraging this, but in case you want to test it out, you want to experience what is it like to buy a put, you can buy it maybe just a couple of, I don't know, days before the election or before a certain, I would say, earnings report. Maybe not a couple of days, because if you buy it before a couple of days, it may be a bit expensive. So you can buy a slightly longer term one to say that maybe this company, the earnings will be very bad. You can buy, but this one is a little bit more speculative, I would say that. So I myself, I don't do it that much. Okay, let's move on and look at some of your hot pens by Tesla.
Yeah, so this one is what happens when people short the market too much. That's why I warn you all, only 5%. Because some people short too much and they short the wrong company. They short a very good company, then they get burnt. So please don't be burnt like those Tesla shorters.
So Elon Musk like to go and fight those short people. Damn it. Okay, never mind. So okay, what's the difference between buy put and sell call? When do you use the strategy?
Okay, so the main difference is buy put is almost unlimited return, sell call is limited. And
buy put is unlimited return, sell call is unlimited. Okay, so what's the difference between buy put here and sell call here, correct?
Yeah, okay. So for sell call, right, you can still be a bit bullish. Of course, the company increased a bit, still okay. But for buy put, right, you must make sure that it's very negative, then you go in.
Yeah. So when you buy something, right, when you buy put, you have to pay money. So I put minus money, correct? And then you are waiting for the stock price to drop, and that's where you make money. For sell call here, sell call, you collect money, you collect a certain income, and then actually for sell call, you have an obligation. So now this is something, right, that if it's not done well, it may go against you. So sell call, remember, you have the obligation to sell your stocks at a certain strike price. So in this case, right, just a very quick, I would say, revision. So meaning to say, example, the stock price now is, again, $10. We put at $10. Then you sell a call. You sell a call at, let's say, $12. Okay? Every time there's this thing called strike price. Remember here? Strike price. Okay? When you sell a certain strike price, right? What it means is, right, you collect money, and you have the obligation to sell at the strike price. You allow someone to lock in your stocks, So someone, I'm going to put someone, I'm going to put an unhappy face, okay? Because when they go against us, they will be unhappy. Okay, anyway, this person, he can lock in your price at $12. What it means is, right, he can buy, remember, he can buy. You have to sell to him. So this is you're happy. Oops. Okay, your face looks a bit odd shape, but you're still happy. So your stocks, right, you have to sell stocks to him at $12. And this is guaranteed, okay, for that time period. And because of that, you collect money first, okay? Now, what happens if the stock price increase to $100, right? $100, think about it this way, $100. Your stocks is now worth 100, but you still have to sell to him at $12 because you pocketed his premium initially. This is something, this is a different strategy. It's more like an income strategy. When you sell, it is typically more of income based. When you buy, right, you are looking for stock price movement to actually gain the capital appreciation either upwards or downwards. So Yeah, you can revise the video where Kun Hong actually mentioned this. Oops, is it covering? Yeah.
Because from the sell call, even if the stock price go up a little bit, sideways or down a bit, you still earn money. But for the buy put, you must drop a lot, then you can earn.
Oh yes, correct. So
So it's
when you sell option, right? If the price never move, you still make money. But when you buy, they must move before you make money.
So the left side is low risk, low return. The right side is high risk, high return.
Say again.
So sell call is like lower risk and lower returns.
Sell is lower risk, lower return. Oh yeah, lower risk, lower return. Typically, lower risk, lower return. Okay, depends on how you allocate your cash. Must be careful. This one is a slightly higher risk, but this one the unlimited returns. Not really unlimited, but higher. Yeah, correct. A lot more.
Yeah.
Cool. Okay. Any other questions? How to compute break-even point? Actually, the options chain will compute for you, correct?
They will compute.
Would you recommend to let buy put to expire to maximize time delay as well?
No, don't ever let it expire, because expire means you lose everything already.
Yeah.
You
So
must
remember right now your son, now you're buying, correct? I mean, in this scenario, the example is you're buying. So as we mentioned, right, when you buy, there's a certain time from now, July, until November. So every how about you go to the time decay slide? You want to mention this, right?
Yeah. So at first it's the 120 days. It's about the time frame for
example is July, correct? Example July. Then this one is in November, correct? Example. Did I calculate correctly? Around there. You get it right. You continue talking. Let me count.
Okay, so for in case the position is earning money, right? You must exercise on the last day. Don't wait for it to expire. Because once you expire, you just lose it.
Once this expires, it's worthless. Yep.
Yeah. So you must execute it before it expire. If not, you just paid money for nothing. You could have earned money, but you didn't.
Yep. So you can see this option, right, when it expires, remember now you're buying. So you're buying means you pay money to actually hold on to a put option, which is an insurance contract, like what we tell you guys, right? So this put option, right, what happens is this particular thing, there is value. You already paid money for it and there's value. So the value is slowly diminishing. Can you see options value is slowly dropping as month goes by, especially until the last 30 days. Actually, in fact, the last 120 days, it will go quite fast already. But the last 30 days, it will drop a lot. By the time it expires, you cannot use anymore already. Therefore, this whole entire put on the last day will be worth $0. You can see right here will be zero. So don't let it expire. Make sure that you either close and get back some money. Close means you sell away the insurance. Going to expire, will people still pay money for it? Answer will be still yes one. Inside the stock market, there's a lot of people one. Do you know that in America, right, a lot of people, they did a study. Do you know that I think like 16 million or don't know how many millions of people in America, they think that brown milk comes from brown cow. Okay, so don't worry, you can find this kind of people. Okay, I feel a bit sad for them. We should educate them, but there will be endless amount of this kind of people to actually pay you for your options. Okay, cool.
In fact, I don't recommend closing on the last day. Usually, got two scenarios. One is if you guess wrongly and the price shoot up too much already. Once I see loss of 50%, I think I will close already. So I limit my loss.
So your exit plan, you close at 50% loss. 50% loss, okay, and then 50% gain. 50% loss or gain, okay. So it goes up 50%, then wow. So his is a 1-to-1 kind of a risk to reward ratio. So this is scenario one. Scenario two.
Scenario two, if you wait until too long, like only left around 30 days left to expiry, no matter earn a bit or lose a bit, I just close also because the time decay too expensive.
Yeah. So the last 30 days here, right, you must wake up and then remember to close. If you forget, then the worst case is if you forget on the last day, it becomes zero. But okay, the brokerage firm will exercise for you and stuff like that. But the key thing is this. So this one slightly you need to monitor a bit, okay, because stock market is going up most of the time. If it fluctuates, goes down, you should actually close already. 50% loss is on stock price or on premium paid.
Or is a premium, because the stock price don't need to drop so much before the premium decrease by 50%.
Oh, so understand now, it's on the premium. So if you pay just now, we paid 1110, correct? So half is
Then you see 5.0.
5.5, right? Is it
5.05?
5.05, 5.05, what? 5.05 you have to get out already. Okay, great. Yes, Esther is actually saying this as well.
Actually, it's 5.5.
Okay, are you guys learning something so far? Is it useful? If it's useful, can you please help us smash the love button? And also, do you guys want the notes to these notes? If you want the notes, can you please type notes as well? And help us click the share button so that more people can actually benefit from this and learn how to short the market. Actually, we don't want people. No, don't share. No, I'm just kidding.
And try not to do this too much because I so rarely do this. Because most of the time, the market go up in general. So just occasionally do it. But don't rely on this.
People to share.
It's good to know rather than they use the traditional method. But try not to use it.
Okay, no. So share so that they can listen to our warning to know that they shouldn't do this too much. So don't play fire, then we show them how to play fire. Okay, but anyway, the key thing is this because some people they will play fire anyway. At least they get a proper education, correct? So now let me share with you guys how to get these notes. Can I share your wait. Where's your link? Wait. So you say something first. I pull up your link.
Yeah, so some people will always like to short the market. So instead of letting them randomly do their own stuff, I rather teach them the less risky way. It still is risky, but it's at least more controlled and not as dangerous.
Risky but riskier way. Okay, but I really want to thank Kun Hong a lot because during these 4 sessions, right, what he did was he really share very, very freely about how to do options, and he's very realistic about things. Now, when I first met him, I tell you I don't really like him now because he always talk about Tesla. Wow, he put a lot of money in here and there. But after these 4 sessions, I realized, wow, this guy is actually a very solid investor. Look at him, so young, so good looking. You think you're good looking? Okay. So anyway, let's come back to the more not subjective thing. This is his page. Then he will actually talk a lot more about options. You can go back and rewatch the videos here. We will also play some of the notes down here. And then that's where you can actually learn more about options from him. If you love to learn more about options, please type options because he's the BiOptions scientist. Meaning to say, why BiOptions? Because he's studying bio. He's a bioscientist. He does that in a very scientific way. He breaks it down into small details so that we can all learn. Okay, cool. So this is one thing that you guys can actually learn more from him as well. So please type options and please learn from the BiOption scientist. Another thing is this. Okay, this one quite exciting. On this coming Saturday, we have a workshop. Hey, do you know about this workshop, Akuno? This Saturday, we have a workshop on ETF. Now, if you guys want to learn more about ETF, please type ETF. Kun Hong, do you use ETF? Just curious.
Sometimes I like the QQQ one.
Oh, okay. So ETF is a little bit useful, right? Especially if you are a beginner and you have some issues about finding which stock to go for, but you believe in a certain sector. So example, if you think that the oil and gas sector is going to go into ruins, correct? You can buy put on the whole entire oil and gas sector instead of choosing exactly which stock to buy, correct? So oil price goes down, they also go down. Possible. Now, this Saturday, we are having a free ETF workshop. How many of you guys love that? Okay, so you can type ETF and we're going to actually share exactly how to go through all these ETF. So Chloe will be telling you guys how to actually invest in ETF, the criteria, how to evaluate, and also using screeners. This entire workshop is absolutely free because we want more people to learn and invest wisely. So I do hope that, how many of you guys want to attend this? If yes, please type yes. Now I'm just going to put a link here, and very simply, what you can do is come to Next Level All-Star Group, come into this particular group, and then that's where you can find one of the posts being pinned as the announcements by Wendy. So look for this post, and then do us a favor, come here and comment below. Help us comment which sector of ETF do you think is most likely to go up or even go down. Type the sector, and then we will get Chloe to go through some of these sectors, teach you how to find it. Is it technology sector? Is it food sector? It can be specific things. How about jewelry? How about tourism sector? Please go to this particular group. This group is free to enter as well. And please comment. After you comment, click on the share button and help us share this so that more people can benefit. So I do hope that you guys enjoy all these workshops, and I do hope that you enjoy the Options 101 with Kun Hong. Now, Kun Hong, your last pitch for why they should buy Tesla.
No, I shouldn't recommend stocks. It's just my personal one. No need to share.
Wait, I find a boo button. I don't have the boo sound effect. Boo. Okay, yeah, we are not recommending stocks, but basically, we want to really share a lot on our opinion so that more people can benefit, and that's where all of us we can level up, right?
And
Okay,
what
great.
I teach is strategies, but the fundamentals I didn't teach. So like how to choose. So if you want to start easy, you can go to the ETF one. Then you apply what I teach to further enhance.
The ETF one is the low level one. For Kun Hong is the high level one, correct? Look down on us. Pui. Okay, so no boo button. Boo boo. Okay, I'm just kidding, guys. I just like to throw him. He's a good friend, very funny guy. So I do hope that you guys have learned something, and then we will see you guys soon. I think Kun Hong got a lot more knowledge on options that you want to share. These are only 4 basics option strategy. You can pair them together. You can actually do 2 or 3 like combination. We call them legs. We haven't talked about repair strategies. We will also invite Kun Hong back to talk about repair, right? So make sure we actually get a repair strategy out. Maybe it can be a workshop by itself. So I do hope you guys have enjoyed yourself and really follow Kun Hong on his page. And we'll see you guys around on the next level page, on Kun Hong's page, and also on our YouTube channel. All right, have a good time and lunch, and we will see you guys soon.
Yeah, see you guys.
Bye-bye.